Hi, thanks for visiting my channel. Topic of today's video is why parents should think twice before adding a child as a joint owner to the property they own. Let me first explain what's joint ownership. Joint ownership is also called joint tenancy, where it's a shared ownership of a property between two or more people with the right of full use of the property by both owner in their lifetime, and upon the death of one owner, the share of the deceased owner is automatically transferred to the surviving owner. It's very common for spouses to hold assets as joint tenants, but the primary reason why people add children as joint owners to provide immediate transfer of the property from parent to child upon parent's death without going through their will to avoid probate fees payable by their estate. Probate fees in Ontario are approximately 1.5% of the total estate value, which works out to be $15,000 on the property worth $1 million. It might make sense in very few circumstances where you might consider adding child as a joint owner of your house if this child is your only beneficiary of your estate and you want to make sure that the property gets transferred directly to your child without you leaving the house in your will and child paying the probate fees. Before we start talking about the reason why you should think twice before adding a child as a joint owner of your house, if you are new to this channel, my name is Tanveer Chaudhary. I'm a certified financial planner and real estate investor. I make educational videos regarding wealth building, financial planning, and real estate investing. If you think you'll learn at least one new thing from this video, all I ask is to like this video and subscribe to this channel so it encourages me to produce more valuable contents for people like you. First reason not to add child as a joint owner of your house if this house is your primary residence but not your child's primary residence. Your house could lose the tax-free status using the principal residence exemption under the Income Tax Act. If child lives somewhere else and own another principal residence, this house will be considered their secondary residence, so it will be subject to capital gain tax when the house is eventually sold. Capital gains tax your child pays due to the joint ownership is often higher than the state administration tax or probate fees you're trying to save by adding the child to the title of the property by reducing the size of your estate. There are very few things in Canada which are tax-free, principal residence being one of them. By adding a child as a joint owner, you might end up converting 100% tax-free asset into a 50% tax-free asset. Let me give you an example. Let's say you purchase a house with your child as a joint owner for $500,000. This house is your primary residence but not your child's primary residence. If the house is worth $1 million upon your death and child is in 50% tax bracket, the child portion of the house will be subject to capital gain tax. Therefore, in order to save a $15,000 probate fees, you could end up losing $62,500 to CRA as capital gain tax. Second reason not to add child as a joint owner of your house because property could be exposed to child's business or personal creditors if child or their spouse run into financial troubles and you could end up losing the house. Also, in case of child's marriage breakdown, the 50% of the house could become part of the net family property for the division of assets between spouses. Third reason not to add child as a joint owner of your house because you will lose control in decision making in regards to the house. Since child is now the joint owner, you will need their consent to sell the house for whatever reason, either to downsize to a smaller house or use the sales proceed to live off of in retirement. You will also need their consent if you need to refinance, set up home equity line of credit, or reverse mortgage against the house to access tax-free cash to supplement your retirement income while still living in the property. On the other hand, child listed as joint owner will also need your consent to either sell or remortgage the property. Fourth reason not to add child as a joint owner of your house if this house is your only asset and you have more than one children. If you list one child as a joint owner, he or she will become the sole owner upon your death. Your estate may not have any other money to leave to your other children. If your intentions were not clear and not very well documented, your other children might challenge the joint ownership, will increase the legal cost, might create rift between children and diminish the value of your estate. Another common mistake I see where parents own two properties, one being principal residence and one being rental property. If they have two children, they end up leaving principal residence to one child and rental property to another child, thinking that they're treating the children equally. This could have unintended consequences since principal resident passes on to your children tax-free, while rental property is subject to capital gain tax upon your death. Therefore, child with the rental property will end up getting the shorter end of the stick and will receive less after-tax net proceeds upon your death. That's all for this video. If you think information like this can benefit someone, please share this video with somebody you know. Also like, comment below, and consider subscribing. Thanks for watching and see you in the next video.